If you know absolutely nothing about investing or the stock market in general, this is the video for you. I'm going to cover some common terminology as well as some different approaches in terms of investing in order to build your wealth. I do know that I'm not going to be able to cover all of the terminology. I'll cover the basics, I'll cover what you need to know to get started, but the best thing you could do is whenever you come across something that you don't know or you don't understand, just write it down and Google it. It's really that simple. And if you don't want to Google it, just leave a comment down below and I'll do my best to try and explain it. Now, before I get into the actual content of the video, I do want to throw out a few warnings just because there are a lot of things that you should know before you start investing. Number one, investing is a risky business, especially investing in the stock market. You do run the risk of losing everything you have, and nobody can guarantee a profit. Warning number two, only invest with money you can afford to lose. Now, what do I mean by that? Let's say you come across a $20 bill that you didn't know you had. That's money you can afford to lose because you didn't know you had it in the first place. It wasn't exactly necessary for you. So that's something you could invest with. Something that you would buy, say something that you would spend on some random thing on Amazon. That's money you can afford to lose because it's something you definitely don't need. But money that you would use to pay for your rent, money from your savings account or your emergency rainy day fund, do not touch that. Do not use that money for investing. Leave that for your rainy day. Leave that for an emergency. Don't touch it. Make sure you have your finances in place first before you do anything else, so you can pay your rent, your bills, whatever you have. Warning number three that I have for you is something that a lot of people ignore, which is diversification. You might have heard the term, don't put all your eggs in one basket. It's a common investing term. And it's true. You don't want to put all your money in, say, Tesla in hopes that it will go even higher. Let's say I'm looking for a new company to invest in. I find one, their finances are great, their reputation is amazing. I still wouldn't put all my money into them because what if something goes south? What if the CEO just goes on a Twitter rant and just ruins their reputation? Stuff like that can happen in the blink of an eye. Now, for number four, this isn't much of a warning, it's just something that you should do, is buy low and sell high. Obviously you don't want to lose money, right? Now, let's say, for example, you buy a share at $10. You want to sell that share for more money than what you spent on it. So $11, $15, $20. You don't want to sell it at $9 or at $7 because you'll be losing money. Stocks just go up and go down all the time. It's what they've done, it's what they're doing, it's what they're gonna do. Don't let your emotions get a hold of you. Relax and hold. Now, my last warning for you is to fact check everything. Never get your information from one source. Look it up in other places. Even everything that I'm saying in this video, look it up in other videos, look it up in books, ask people, see if what they say is the same thing. Because if many people are saying the same thing, odds are that it's true. But if you find one article or one video that's just saying one thing and nobody else is saying the same thing, or they're saying the opposite, odds are it's either bad advice, bad news, and you should stay away from it. One last thing that I want to say, that when it comes to different methods of investing or trading, if you're a beginner, stay away from day trading. It's very risky and very expensive. And I'm not going to go into details as to why that is. Just know that it's very risky and very expensive. Obviously, I'm not your dad, so do whatever you want. Just take it with a grain of salt. Now that we got all the warnings out of the way, there are many tools, many resources that you can use in order to secure your money as best as you can. Sure, we're all taking a risk when investing, but it's an educated risk. It's a calculated risk. So, how do we start buying stocks? The first thing you're going to need to do is go to a website or an app and create a brokerage account. Before creating a brokerage account, you might want to consider a paper trading account. A paper trading account is the same as a brokerage account, except you're not using real money. You're not using your money, you're using fictitious money. And you could see how the trades go, and you could see how your money grows or how it declines. It's something so you can get a feel of the market. I recommend you do so just so you can get a feel of it and you don't panic and lose all your money right away. Now, in terms of where you should create your account, the most important thing to remember is that you want a site or an app that has zero commission trades. What this means is that whenever you buy a share or a fund or anything, it doesn't have a fee. Now, here's a small list of sites that you can use. Another feature that you might want in your brokerage account is fractional shares. So every week or every other week or every month or however often you want, you can funnel in a little more and a little more and a little more until you own a full share. Once you know what site you want to use to create your account, you're going to see that there's different types of accounts. There's going to be an individual brokerage account, there's going to be a traditional IRA, there's going to be a Roth IRA, there's going to be an automated something. It's going to differ from site to site. But the two main ones you need to remember are going to be an individual or a brokerage account and a Roth IRA. Now, the brokerage account is for all of your trading, whether if it's short-term or long-term. That's where you put your money in to do all the trades. Anything you sell on this account will be taxed in the same manner as your work paycheck, for example. When you get a paycheck from work, you're going to get a pay stub and you'll see how much was net, how much was gross, how much was tax, so on. Now, when it comes to the stock market, it's referred to as capital income. Even if when you make any type of sell and you don't transfer it to your bank account, you're still going to have to pay taxes on those sales. The tax forms will be provided by the brokerage. You can contact their support, or usually there'll be a little thing on the top. It'll be a 1099A or 1099B form. And with that, you just file your taxes as you usually would. Now, on the other hand, we have the Roth IRA, which is a retirement fund. Just like a 401k, you consistently put money into it and just watch it grow. However, since it is a trading account, just putting money into the account isn't going to mean anything. You do need to buy something with that. Now, you can buy individual stocks, you can buy ETFs, you can buy bonds. Now, the main benefit of a Roth IRA over a 401k is that when you take the money out, it is completely tax-free. A 401k will take your pre-tax money from your paycheck, in other words, your gross income, and invest through there. Your Roth IRA, you pay with your already taxed money, in other words, your net income. Anything that you would use to pay for your bills, anything that you would use to pay for rent, etc. The main downside to a Roth IRA, however, is that you can't withdraw anything from that account until you're 59 and a half. However, there are some exceptions in which you can, but we'll go over that in another video in the future. For now, just know that you can't touch the Roth IRA, and you shouldn't touch it because you want to see your money grow throughout time. So now you got your account approved, you linked your account, you transferred funds to your brokerage account, and you're ready to start investing. Now what? I don't see this is like a regular store and I could just go buy stuff and add to cart. What you need to do is look for a search bar or look for something that says trade. This is referred to as trading. Now, once you find that, you're going to look for companies using ticker symbols. In the market, they use ticker symbols to abbreviate the company. Tesla has a ticker symbol TSLA. Microsoft has a ticker symbol MSFT. And there's going to be an option to buy or sell and what kind of trade do you want. Do you want a market order? Do you want a limit order? The market order is just going to be, whatever the market is going for at the time. Now, a limit order is a little different. Let's say you want to buy a bunch of shares, but only if it goes down to this price. Let's say the stock is at $20 and you want it to go down to 15. That's where you're comfortable buying at. So you put a limit order at $15. And once it hits $15, then your transaction will go through. If it hits $15.01, your transaction won't go through. All of these trades are only executed when the market is open from 9:30 to 4 p.m. New York time. So you're going to see a lot. How many shares do you want to buy? How many shares do you want to sell? How many shares do you own? You still don't know what are shares. A share is just a small portion of a company. So say you buy one share of Microsoft, you own a part of Microsoft. A share just symbolizes ownership. But here's $1 million question. How do you know what company to invest in? How do you know a company is good to invest in? How do you know if a company is not good to invest in? You can't just depend on someone to tell you, oh yeah, this is a good investment, this is a really good company, or this is a bad company, stay away from it. Even if they're right and you invest in it, you need to know why it's a good investment. Because if they go through some hard times, you need to know how it affects that company, and if you need to sell your shares or if you need to buy more, or what you need to do, what action you need to take. You always need to understand why you invested in a company and what will affect that company, whether if it's in a negative fashion or a positive fashion. One thing that helped me get started is that I invested in companies that I understand. So I understand the company, I understand what they do, I understand how the market affects them, I understand how their products will do in the future and how that will affect their shares and so on. But let's just assume that you don't know any companies, you don't know any sectors, and you have no idea what to invest in. I assure you that you do know companies and you do understand companies. Let's take Apple, for example. You got MacBooks, you got iPhones, you got iMacs, a whole range of products. Everybody in the world knows what Apple is, and better yet, there's a bunch of people that love their products and will only buy Apple products. But how do you research Apple to know that it's a good company to invest in? There's two ways: through technical and fundamental analysis. I'm not a fan of labeling analysis and saying, oh, this is this type of analysis and so on. I see something that I think is important and I just research that. Number one is to check the summary of the stock. The first thing you'll notice is the price of a single share, which is currently this much, and how much it changed today. The chart underneath shows the price of a single share throughout its history. With this chart, you can easily tell if a company is volatile or not. Now, volatility is how much a company's share price grows or falls in a short period of time. Now, about all the little numbers over here, again, I'm only going to point out the ones that I think you should be looking at as a beginner. I'm not going to point all of them out. Previous close is the price one share cost last time the market was closed, and open is the price when the market was open. Pretty self-explanatory. Volume is very important, if not the most important one here. You want this number to be very high, because if you buy into a company that has a low volume, that means it's going to be harder to sell your shares since not many people are looking to buy it. The higher the volume, the faster your trades will execute. Market cap is another one that's very important. This tells you the value of the company or how much it's worth. Earnings date is the date the company is expected to release their earnings for the quarter. Now, this is a very important one because you want to stay up to date on how much a company is earning, how much money they're making, how much money they're losing, how much debt they have, how much debt they're paying off, so on and so forth. For dividend and yield. Now, first off, not every company offers a dividend, so you might not see a value here. But the ones that do will give their shareholders a certain percentage of their holdings back to them. In this case, Apple will give you 0.93% back to you for all the shares you own every year. I'm not going to talk much about dividends since I already made a video about it. I'll leave a link down below if you want to learn more about that. Now on to the second step of research. No, number one was a long one. Does the company have a good product or a good experience? Do people like it? Keep using Apple as an example. A lot of people love Apple. They make very good computers. Everything's very high quality. Now for number three, what do they do to bring in money? Aside from the obvious, which is selling products, do they have anything else they do? Staying up to date in these kind of things is key. You need to know what is going to happen before the rest of the world does. Again, this is a lot easier if you invest in companies that you know and understand. Number four, are they keeping their money? Do they have any debt? This is one of the most, if not the most important item to research when looking into a company. To know more about this, you can go back to Yahoo Finances and look up the company you want to research. And there's going to be a tab that says financials. From there, you can view the income statement, the balance sheet, and the cash flow statement. I made a whole video explaining the most important points of all of these, which will be linked below if you want to check that out. Now, lastly, for number five, the investor relations page. Things you'll see on here is the latest releases, future releases, the latest news, their latest financials, their Securities and Exchange Commissions filings, otherwise known as SEC filings, lawsuits, if any, so on and so forth. You can find a lot of info on the investor relations page, and I highly recommend you check it out. Now, the last piece of advice that I have for you is to be social. Talk with people. Talk to other investors. The first place that I would recommend you check is your bank to see if they have any financial advisors there. If you're still in school or you don't have a bank account, maybe you can see if there's an economics teacher. Now, the place where I met a lot of people is on Discord. For those of you who don't know what Discord is, it's like one giant group chat. Another YouTuber by the name of Nate O'Brien made a server. I joined and I talked and met a lot of people. I'll leave a link in the description if you want to check that out. If you do have any other questions, just drop a comment down below. I'm more than happy to talk to anyone. Thank you for watching and happy investing.